Alright, hello everyone. Welcome to my YouTube channel. Today we're going to go over something very exciting that I know everyone just can't wait for. This is the capital asset pricing model. You will find this concept in many of your Introduction to Finance courses. So let's get right to it. What is the capital asset pricing model? So basically, if you look in a finance textbook, this is the kind of definition that you'll get. It is a theoretical concept that measures the required rate of return of an asset by taking into account the sensitivity of other assets' returns to the market returns. So it divides it into two major components: diversifiable risk and non-diversifiable risk. What exactly does that mean? Because that sounds like a whole lot of nonsense. Simply put, basically the CAPM formula finds the minimum required return an investor should receive for investing in a stock at a given level or risk. So basically, let's say you were to invest in Apple stock or Google stock or Amazon stock. Basically what this formula is going to spit out, once you do all the numbers, is a percentage, and that percentage is the minimum return that you should receive for investing in that asset. Okay? Takes into account the risk that you'll take on investing in that asset. So this is the minimum required return. So here's the formula. Don't freak out, don't freak out, don't freak out. Relax, take a deep breath. Not that bad. We're going to go over, looks bad, but we're going to go over all of the different parts of it. Okay. So RI, like I said, that's what this formula spits out. That's the required return on the stock. That's the minimum amount that you should take for investing in this stock. RF is the risk-free rate of return, which I will go over in the next slide. Beta of the stock is basically that beta symbol. That's beta I. It's the beta of the stock. And RM, which is in the parentheses there, is the return on the market index. So basically the return that you would get if you were to invest in the S&P 500, which is the most often used index that they use for these kind of calculations. S&P 500 is just a better indicator of the market as opposed to the Dow Jones or the Russell index or anything like that. So you're probably going to use the S&P 500. And then minus RF, that is the risk-free rate again. So we'll go over that. I want to make a note here that the part in that parentheses there, the RM minus RF, this is sometimes considered the market risk premium or excess return. So sometimes in a problem, they'll give you either the return on the market, and you'll have to subtract the risk-free rate from it, which is in that parentheses, or they'll just give you a risk premium, and then you will multiply that by the beta in the formula. So we'll go over an example of that. So don't worry too much about that right now. I'll get to that at the end of the video. The risk-free rate of return, which is one of the components of the CAPM formula, that is this right here, the risk-free rate of return. So the risk-free rate of return is the theoretical rate of return on an investment with no risk. Now, technically, this is a misnomer because all investments carry some level of risk, but there is a type of asset that you can invest in that is considered by finance people to be a risk-free, it'll be a risk-free investment, okay? Usually this number comes from a government or treasury security like a T-bill. Now, you hear that and your eyes glaze over, I understand. But basically, it's saying that if you invest in a government security, bond, treasury bill, something like that, you'll get back a return that is considered risk-free because theoretically, the government is not going to default on its debt because it can either tax or it can print more money in order to satisfy its debts. So you won't be, if you invest in one of these securities, you won't be left out to dry. Okay? So often this number comes from either a 3-month or a 10-year T-bill. Like I said, government securities are considered risk-free because the government can either tax or print more money in order to pay off its obligations. And here's a picture of the Treasury yield curve rates. You really don't have to know anything about this. This is basically what a yield curve would look like. And this is where you'll get your risk-free percentage. Beta. So the beta is the next part of the CAPM formula. Beta is right here. Okay. We won't get into how to calculate beta today because that's a topic for a whole nother video. But basically what beta is, and the number that pops out, this is not a percentage. This is just an integer number. And it's, for the purposes of the CAPM, it's usually somewhere between 0 and 2. Okay? So this is an indicator. Here's the definition. It's an indicator of the riskiness of a stock's returns as compared to the riskiness of the general market returns. Okay? A beta of 1, if the beta is a 1, it has the same risk as the general market, but a beta lower than 1 is less risky. A beta higher than 1 is more risky than the general market. So if it's 1.3, it's more risky than the general stock market. If it's 0.7, then it's less risky. And here is a table of a couple different betas that you'll find with certain stocks. So like Apple has a 1.38 beta, which means that it moves like the market, but it moves at a higher magnitude than the market. So it's considered more risky. And if you look at, like, let's say Gap also moves in the same general direction as the market, but it moves with less magnitude. So it's considered less risky than the market. So let's say, for example, the market moved up 10% in a day. That would mean Apple moved up a little bit more than 10% that day. Moved in the same direction, but with a higher magnitude. And if the market moved 10% in a day, you're looking at the S&P returns and it moved 10% in a day, that means like Gap or whatever, since the beta is lower than 1, that means it'll still move in the same general direction as the market in an upward direction, but it won't be a 10% move. It'll be less than that. So that's basically beta. Okay. The return of the market, or RM, this is pretty simple. That's this little guy right here. The return of the market is the average return on the general market, like the S&P 500, like we said earlier, over the time span being observed. So if we're trying to do a CAPM formula for a 1-year period or something like that, you're basically taking the average return of the market for that year. Or if it's over a 6-month time span, or if it's over a 5-year time span, you're going to take the average return of the market. So that's what that is. So let's go over an example. This is a pretty standard example that you'll find on a CAPM related problem, or a homework problem, or a quiz problem, or anything like that. So let's say XYZ Corp has a beta of 1.3. So basically it has a beta that's similar to JP Morgan and Chase or Apple. Okay. But you don't have to know that. XYZ Corp has a beta of 1.3, while the market return is 8%. So in this time span, the market generally gave us an 8% return, and 10-year treasury yields are currently at 3.5%. So that is our risk-free rate, okay, because it's the 10-year treasury yields. What does CAPM say about the required return of XYZ Corp stock? Okay, so this is basically the formula: risk-free rate plus beta times the market return minus the risk-free rate. And that's how this is set up, okay? This formula here. So if we go back, 0.035 risk-free rate, right here, 3.5%, plus the beta, 1.3. That is not a decimal, so we don't have to switch to decimal places or anything like that. So 1.3 times the market return, which is 8%, minus the risk-free rate. If you simplify this problem, 0.035 plus 1.3, okay, we simplify the parentheses, and you go all the way down. The required return on XYZ stock is 9.35%. So this is the minimum return that you should require if you invest in XYZ Corp stock. Simple as that. So CAPM is telling us that if an investor invests in XYZ Corp stock, he or she should be compensated a 9.35% return for the given level of risk taken on. So if you put $100 into XYZ Corp stock, by the end of the time period, you should be compensated 9.35%, or $9.35. Otherwise, the stock is not worthwhile, given the level of risk taken on. And that's what CAPM is telling you. So another example that's rather similar. I wanted to talk about before I end this video. XYZ Corp, we're going to still go with XYZ Corp, but we're going to switch the numbers a little bit, has a beta of 0.7, so less than 1, has a beta of 0.7, and the 10-year Treasury yields are currently at 2.9%. The market risk premium, so it's not giving us the market return this time. It's giving us the market risk premium is 6%. What does CAPM say about the required return of XYZ Corp stock? So, like I said earlier, I wanted to make a note that this section here, the parentheses, is sometimes considered the market risk premium. Sometimes they'll give you this in the problem as opposed to the market return. So basically, if they say the market risk premium, which is what this is, what was in our problem? 6%. So all you have to do when you put it in the formula is you don't have to do that whole parenthesis. You don't have to do that whole RM minus RF thing. All you do is put in the market risk premium, which is 6%, times it by your beta, which is 0.7, plus the risk-free rate of return, 2.9%. Put it all together, blah, 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 and your answer is 7.1%, which means CAPM, Capital Asset Pricing Model, tells us that if the investor invests in XYZ Corp stock, he or she should be compensated a 7.1% return for the given level of risk taken on. And that, in a nutshell, is CAPM. Now, in the next video, what I'd like to do is sort of take CAPM and use it in a real-world example so that you can actually do the calculation. If you wanted to do this in Excel, I'm going to do an Excel sheet of the actual calculation that you can go through over a 5-year time span in order to come up with the required return of a particular stock. So we're going to do that in the next video. But thank you for tuning in, and I hope you got something out of this. Have a good day.